All right. Hello, everyone. Welcome to today's webinar. We're going to be talking about how to expand your financial literacy by budgeting, saving, and investing. I'm Jenny Taylor, one of the investment advisory reps with TRADEway. And thanks for the little heart there. Somebody gave me a heart. I'm joined with Pepper Posey, the executive director of AMPT, as well as Ben Russell. Hi, Ben. He's the senior investment advisory representative within the AMPT division, as well as, he pretty much wears every hat that an IAR can wear. So we are excited to be here today to talk a little bit about how to expand your financial literacy. And, this is kind of more of a ground level topic, but we felt like we got a lot of clients and some even younger clients in our database now that maybe need a little refresher on budgeting. So we're going to spend some time talking about those things, and what we hope is that you can have a greater opportunity to glorify God with your finances after watching this and taking part of this. So I think as Christians, we probably realize whose money our money is, right? I think we realize that it is God's money, but is that kind of flowing through maybe in how we are spending or how we're saving? Is it even a thought every time we swipe our card when we buy something? So what I want to take a minute to talk about is kind of where do we see in the Bible how we're supposed to, act towards money when it comes to our spending? And we see in the parable of the talents that we're supposed to be a good steward. Of course, there's other verses as well that talk about being a good steward of the Lord's money that he's giving us. But really, I think the best one there is that parable of the talents, where he gives money to 3 different people, and 2 of them take it and double it. And he calls them good and faithful servants. And then the 3rd one actually buries it, right? At least none of them just went and spent the money that he gave them. But the 3rd one buries it, and he gives him back exactly what he gave him. And he wasn't happy with that. He's like, why didn't you at least put it in the bank, right? So we take, there's entrepreneurial aspects, of course, of that parable, but also just God wants us to be a good steward with what he's giving us. And of course, we realize that we are supposed to help our local churches and our pastors and help those in need. And I really take, that from the book of Acts, and people felt the Lord lead them to actually give up everything they had and support the 12 apostles and Paul as they, in essence, started from the ground floor and built the church. They needed finances to go out and travel and share the gospel. And our churches still need our help. Our pastors, a lot of them, that's what they live off of, is what the church provides them. So we are to give to the church and help those in need. And in 2 Corinthians, of course, we see that if we sow sparingly, we're going to reap sparingly. And if we sow abundantly, we would reap abundantly. So the Lord really wants us to give from our heart, what he puts on our heart to give to the church. We realize that that's what we need to do. So another thing I would hope from this webinar is that maybe the Holy Spirit would kind of, with our help, with his help, we would realize maybe there's some areas in our finances that maybe he wants us to change. Are we being, is it even, running through our mind when we're, going and grabbing takeout or something, that am I being a good steward of the money that God has provided for us? So with that said, it kind of comes to, we realize, okay, we've got our relationship with Christ and that he is actually our Lord and we need to take finances under his lordship. So what does that look like in how I'm currently treating money? And so what is my current relationship with money? I think we kind of all know there's kind of 2 types of people with money, and those are the spenders or the savers. Of course, there's kind of things in between that. But what I would like us to take from this is, when you are, done with this, there are actually some little quizzes online. You can Google like my relationship money relationship quiz or money relationship test. And there's different ones that you can take that will give you all these different, ideas of what you are and what is that current relationship with money. So doing that, it would be great. But also we have to kind of realize it's a little bit deeper than, oh, this is just what I'm doing. There's a reason that we're doing what we're doing with the money. How am I thinking, feeling, and acting towards money? Am I anxious or fearful about money? Am I scared that I'm not going to have enough money? Or maybe I'm just kind of indifferent to money. Maybe that's one reason why they're, spenders they're just like, it's money, who cares? Right. But we need to realize that whether we're a spender or a saver, what we want to be doing is glorifying God in what we spend on and why we're saving. So if we're saving because we're scared and fearful and not trusting the Lord, then we're really not saving in a way that's glorifying God. If we're saving because we're trying to be, financially prepared and to leave things, for our kids and grandkids, then that's great. But again, if we're doing it because we're scared, that isn't really, you're not trusting the Lord, right? And we also want to make sure we're being good stewards in how we spend. So this might be a little bit of a simplistic example, but the little things that we spend money on really will add up over time. And they can have great impacts to our financial foundation, kind of if we would let them. So here's an example. If we were the person, thankfully this isn't me, but I have those other little areas that I'm like, oh, I'll spend money on this or this or this, right? These little spending habits we might have. But 5 days a week, if we went and grabbed a coffee for $5 a day on our way to work, right? Went through the drive-through, got that $5 coffee a day. We're looking at spending $25 a week on coffee. And then that actually turns out to be $1,300 a year on, takeout coffee. In 10 years, that would be $13,000 that we would have spent on that. In 3 years, that's almost 40 grand. Okay. What do you guys think about that? I think that it's a little bit shocking, I think, to actually run those numbers.
I know why Starbucks stock keeps going up.
That's a good point. That's a good point, Ben. It's a little shocking, I think. And I think it would be a great project for all of us to do this math on our discretionary spending, right? A lot of us have those little subscriptions that we're paying for, maybe online streaming services, different things like that. What is your discretionary spending that you could run this number on and just see, what does that look like? And then maybe ask yourself, what could I do with that money if I didn't spend it on this? Right? Well, one of the things we could do is save it. And the reason why I bring that up is because I have a couple of different stats here that are kind of a little bit shocking, right? In May of 2022, nearly 4 in 10 Americans lack enough money to cover a $400 unexpected expense. Okay. Now that was in May of 2022, could be different, but a $400 unexpected expense, a lot of unexpected expenses are a lot more than $400. So that's a low unexpected expense. And then another one is, according to US Census Bureau data, 50% of women and 47% of men between the ages of 55 and 66 have no retirement savings. That was a lot higher than I really thought it was going to be for that age range in particular. So these two kind of shocking statistics here, along with that discretionary spending example that I shared, may help us realize that we might need to make some changes, right, to our saving and spending habits. But what may be even more helpful to actually affect the change we want made would be to kind of figure out a why and have some goals and some vision for our financial future. So really, we can try to change our behavior all we want, but if we don't have a emotional reason to change or a belief to change, that the behavioral change eventually will probably stop, right? We'll eventually go back to those old habits that we want to change. But if that desire to change is less than the desire to, keep doing what we've been doing, we're going to kind of have conflicting things going on here. We really need to have some goals and visions and reasons why maybe saving a little bit more is better than, continuing to spend. So there's just some examples here. Maybe they could be your why. But a lot of it is we want to be able to give more, right? We want to be able to give more to churches or support missionaries or be able to have some extra money to help friends or family, maybe if they need it, saving for education funds for our children, saving for retirement or investments. If you have more money saved, you can have more flexibility. So maybe some of you are wishing, man, I'd really like to change careers, but I just don't feel like I could do that right now. And if we had more money saved, then maybe that would be, something that you could look at doing. Other people may want to start a business. So to spend some time thinking about some goals or visions for your financial future, and that can help you maybe make some different decisions on a daily basis as to what you're spending your money on. So we kind of have to take a minute and look at, well, what is my current financial picture, right? What is my debt? What interest rates am I paying on the debt that I have? What's in my savings? Do I have a budget? Do I actually follow it? Or do I just have a budget and I just kind of redo it every month and I don't really care if I go over the budget? How much money do I spend each month? Do I actually know how much is going out each month? Really, we've got to have a clearer financial picture of what's currently going on if we think we're going to be able to make some changes down the road. So am I planning for retirement? Do I know what my net worth is, right? And is that increasing from year to year, or is it kind of maybe going the wrong way? We need to get a good picture of where we're at. And the reason why I say this is because if we aren't really being able to manage what we're currently making, right? We're not being able to manage and budget and spend less than I'm making just currently. If we're sitting there thinking, man, if I would just make some more money, if I could just make an extra $2,000 a month, then everything would be fine. I'd be able to save what I need to save. I'd be able to get the credit cards paid off, et cetera, et cetera. But the problem with that is if I can't manage my current monthly income in a way that would, allow me to save or to pay off debt, et cetera, I'm not managing it in a way that is glorifying God, then I'm not going to be able to do it if I made $10,000 more, or if I made $100,000 more, or $1 million more. I really need to learn to be faithful with what I currently have, be faithful with whether that's a little or a lot, right? Be faithful with a little, then that would give the opportunity for God to potentially allow you to be faithful with more. And that's what the Lord wants us to see, is to be being faithful with what he's currently giving us, so that if and when he does bless us with more, he knows he can trust us with it. So I would encourage just all of us to spend some time, trying to figure these things out if we don't know them yet, these questions here on the screen, and then work on towards being faithful in these areas. And if we are more faithful in these areas, then we're starting to build, a strong financial foundation. So there's really 4 aspects to building a strong financial foundation. And the first one is to ensure that I'm spending less than I make every month. We need to spend less than what we're making every month. The second one is if we have debt, we need to pay it off. Now, I am not in the camp that there's only one right way to skin a cat, okay? Some people say you got to get out of all debt, maybe except your house. There's other camps that are like, try to pay off your high interest rate of 7% or more. You don't really need to, just dump everything into the lower, interest rate debt immediately. So I say you need to talk to the Lord about that. How does he want you to get your debt paid off? All of it, or pay off the high interest rate, and then you're going to, make the monthly payment, or maybe make extra payments towards car loans, or your house, or, maybe you have student loan debt. So talk to the Lord about how he wants you to pay off that debt. But number one, you do have to get that high interest rate debt paid off. Okay. Then if you have that high interest rate debt paid off, if that's what your goal was, then you would move to step 3, which is save a 3 to 6 month emergency fund. If you're doing like all the debt, then you would wait on step 3 until you had the car loans paid off, the student loans paid off, all of that. But yeah, the step 3 would be to save a 3 to 6 month emergency fund. I think we all know what that's for, is, if we got laid off, right? Or something else happened where, we needed that emergency fund. Again, if we got laid off, we'd have enough to cover our bills for 3 to 6 months. After that, that's when you would start saving really for investing or saving for retirements. But I also put like large purchases in there, right? So you could start maybe putting at this point, that's where you could start putting aside maybe, $200 a month or something to go towards a car fund. That would be, for when your car quits working, you've got either a down payment to go buy a different car, or, maybe the total amount to go buy a car. So that would be the 4th step, really, is to save for the investments and save for those large purchases that you could be making. So now, that you're like, well, that's great, but how do I actually do any of this? Right? Well, that's where that budget comes in. And if I could get, you guys to raise your hand, if you've made a budget and then just like given up on it, go ahead and raise your hand. I'd like to see how many hands we get raised here, because I think what happens a lot with a lot of us is that we made the budget, but maybe we didn't have, again, we probably didn't have those visions, those long-term visions, those long-term goals. We probably maybe didn't have our why. Maybe we weren't connecting this with, this is going to be glorifying to God by me taking my finances and getting them under control. So I want to present maybe a little bit a better way to budget. And the first step would be that vision that we've talked about. What are some financial goals for the long term, but also short term? And I think setting some short term goals can motivate you to be, more active currently and try to follow the budget right now, rather than just trying to picture, 10 years from now, I want to have X amount in my retirement account. That's really not impacting you currently. But like a short-term goal could be, I have a credit card that has X amount of dollars on it that I'm carrying, and I want to have that paid off in 3 months. Okay. Or I want to have, whatever it is, a short-term goal, right? That's going to motivate you to be more precise with what you're spending your money on. Okay. Secondly, and this goes back to kind of my point 2 of paying off your debt, right? If you're going to work on just paying off the high interest rate debt, and you're not dumping everything into all the debt, then you could also have some savings targets. So maybe you still want to kind of live a little, right, while you're getting out of debt. And you decide that, in 8 months, we're going to take a family vacation, and that you figure out what you think it would cost, and you set a savings target for what that would be on a monthly basis. You need to figure out monthly, I need to save $200 a month. And you can set up an auto savings in your bank account to do that. So set some savings targets, and maybe it's something else. Maybe you're saving $50 a month for a clothes fund because you're going to need to get your kids more clothes in 6 months or whatever, right? So your savings targets can actually be for needs, not just like a vacation. So that would be number 2. The idea is to kind of live a little bit while you're still maybe paying off your debt. But if you feel more like, no, I'm just trying to get out of debt, then you kind of skip that savings target. Number 3, though, is of course the budget. But now, because we have the visions and the goals and the understanding that, this is the Lord's money and we want to be good stewards, we can actually maybe try to, live within the budget a little bit better, because we're going to spend accordingly to what the budget says while we're remembering our short-term and long-term goals. And our budget and spending should be aligned with those values and those goals, and keep that in mind, that we're trying to glorify God and in what we spend our money on, and in saving. So the last thing, though, I think part of the reason why, one reason we might fail with the budget is because a lot of us, this isn't me because I'm like a math person and like, I want to know everything. And I actually like very much enjoy spending time in spreadsheets and all that stuff. And I understand that's not everybody, but maybe for those that don't already enjoy the weekly budget meeting, right? If we make it a time where it's actually maybe a time of worship and praise and thanksgiving to God, maybe that would make it, it'd probably be better to bring it under the Lord's guidance anyways. But maybe it would make it where it's not just this, oh, I have to do my budget meeting, right? So set a time weekly to pray and seek God's guidance as you manage your budget. And this would allow you to stay on track to achieve your goals. And if we bring the Lord into it on that more weekly basis, I really think that that's going to actually help the system work better, but also it's going to help us make those better decisions on a day-to-day basis about what I'm spending my money on. I think we can all admit that we've gotten ads in our emails, or we saw an ad on, a social media site that literally we had absolutely no desire to purchase that before we saw the ad and it got us and we bought it. Right. So if we have these goals and these visions in place, as well as we're bringing the Lord into our finances on at least a weekly, but hopefully daily basis on what we're spending our money on, I do really think we're going to be able to achieve those goals a lot better. So I'm going to hand it off to Pepper now. He's actually going to show you a budget. And we're going to pull that up now.
Those who haven't met Pepper Posey, Pepper is one of the individuals in the background that helps with what happens inside the AMP program. So Pepper's joined. You have a fairly deep and long-term relationship with David Mitchell. And what happened is David's like, hey, can you come in and help us scale the program? Well, I think you're going to be excited to hear straight from Pepper some of the wisdom that he has to bring to the program for us. So Pepper, we're looking forward to seeing this. And you're not going to do a slide presentation. What are you going to be doing?
Well, it'll still be a presentation, but I'm going to use an Excel file. But anyway, first of all, Jenny, thank you. And yes, I am going to talk about finances in regards to your overall spending and also your overall savings for that. And of course, in order to do that, you need a plan. So I want to talk about, the tool that you would use would be called a budget, as Jenny said. And these can, first of all, help you make your plan. Then you use it to track how you're doing on your progress towards that. And then it also helps you identify, maybe I need to make some adjustments on that. Anyway, by the way, you can see my screen now, right? Is that correct?
Yes.
Yep, looks good. I'm looking at a personal monthly budget.
Perfect. And, there's many different ways to do this online are available. And, you can put them on your computer, you can put them on your phone, many different things. But, again, some of them you have to purchase and they're very intricate and detailed, and others not so much. And of course, a lot of them are free also. And the one I chose to use today is actually a Microsoft product, and it is included in Microsoft Excel. So it is free and it looks just like this. So it's a good tool, a relatively good tool to use, and it's free. But whatever you do, find one that fits your needs. Again, whether you do it at home on your computer or on your phone. And the main thing is to stick with it and keep up with it. So we'll just move right into that. And as you can see, from this one, it starts with a projected monthly income. And the numbers I've used here, I've just thrown in some numbers. Obviously, yours will be different than that, but we'll be just looking at some representative numbers and categories and things like that. And of course, you will need to customize it according to or you can customize to some extent on Excel to meet your needs. So, So I chose $110,000 a month, and I was just picking average salary for two people, being about 60,000. So that's where for 120,000 a year. So that's where I came up with 10. So that's what I'm going to use. So that is where we will start. So it starts in different categories. It has housing. And it has the different aspects that you may have for your mortgage, your rent, phone, electricity, things like that. I have split out the taxes and insurance separate, but of course you may put them all together, but I have them separate and we'll take a look at that. But anyway, these are pretty much fixed costs that I would have to use for my housing. And then I've got entertainment. And by the way, you'll notice I put internet is a housing cost and a fixed cost, and entertainment would be actual cable, Netflix, movies, things like that. So again, I'm just putting in numbers. Yours may be different. So I've got what I think I will be spending. It looks like that. So that's why I'm building this as my first step. I then go to transportation. Do I have a vehicle payment? And I put, okay, we got a couple of cars. Let me just throw in $900. If you don't have a car payment, it's zero. And congratulations to you if that's the case. But you have insurance, licensing, fuel, maintenance. The older your car is, that maintenance fee may be a little, you may need to plan a little bit more, but you can look at your last, your past expenses and estimate what you think that'll be. Do I have any loans? In this case, I don't have any. I don't have a car loan. I don't have any student loan, but again, you're fit in what you need to do to do that. Insurance. So I've got my home insurance, health insurance, life insurance to pay each month. I've got my taxes. This would be federal taxes. I think I'm going to, in this case, pay so $18,000 or so. Again, this is taken out of my paycheck, hopefully, but it still is coming out of my paycheck, right? And then I may have school taxes. There may be state taxes where you live, city taxes, or personal property taxes, things like that. But anyway, categories here for you to put that information in. Then we move over to food, and I've just put out regular groceries I get at the grocery store, and then eating out, $600, $300 numbers I put in for that. My savings and investments. Now, this is an important part, particularly, if you're working for a company that offers a 401k and they have some matching funds, you should be taking advantage of that, because that is a great thing and a way to build your retirement funds up. But anyway, so I put, about 8%. Or so, a little bit less than that, maybe 7% going into that. Hopefully I'll be getting matching funds that the company puts in, but I don't include those here. Then I have a fixed savings. Jenny was talking about, saving up for major purchases that you may have coming up, and just have that as a safety net that you can use. And I'll talk about this one a little bit later, but flexible savings, those are, I want to spend less than I bring home, but I'm going to call it a buffer. I always want to save $300 a month in addition to my retirement. I would like to save another $285. Hopefully I can, but this is my, again, my flexible savings are my buffer of things that may happen. Okay, I don't have any pets. My animals roam around from the wild out in my yard. Donations, 10%. So I put in $1,000 for that. For personal care, medical, and this would be out-of-pocket type things, and this may be a little high, maybe. But maybe not. So anyway, I put $200 a month for that. And then for clothing, $120 a month. Hopefully I don't need any legal expenses. And that rounds out my $10,000 a month that I am budgeting for. Now for my next tab here, this is not part of the Excel template that you would get. So this is something that you would build on your own. Relatively easy to do within Excel, and it's just another tab. So again, I put housing budget. I broke that down to my budgeted amount, my actual amount. And okay, for this month, my maintenance repairs, I didn't have any, so I had an extra $100. My supplies for the home, I actually overspent, so I had a minus 50. But I ended up the month in this category having spent $50 less than I had planned, and I just carried that over to the next month, I've got those numbers of how I started with a reserve. For insurance, maybe a little bit different with that because you may be paying your house payment yearly if it's not taken out of your escrow. So you're going to be saving up with that through the year. And I figured I had saved $1,700. And when I got ready to pay my insurance bill, it was actually $1,800. So my variance, it cost $100 more than I thought. So I ended up where my variance, or my savings for that had been 17. Now I have minus 100. So I'll carry that over to next month and maybe even add to it in my case, because I want to not only, I've got to cover this $100 plus the extra $100 that it's going to cost me anyway, because it's $1,800. Oh, maybe it may even be $1,900. So I'm going to increase that to 170 that I want to start next month. Okay. Okay. Now here's one that I really want to talk about, and it's food, but it could relate to any what I would call a discretionary spending. But so groceries, I budgeted $600, and again, dining out $300. But if all I do is at the end of the month see that I spent $120 too much on eating out, I really don't have any fine detail for that. So instead of just having this amount, I'm going to actually break this one down, separate categories for groceries, separate one for dining out, and I'm going to keep individual track as I go through there, because I know from experience what might happen with this. So in this case, my grocery budget, I spent $25 less, so I was ending with $25. On my dining out, however, Taco Tuesdays and lunch at work and going out after church for lunch and Starbucks and eating ice cream at Freddy's. And anyway, I ended up spending $120 more than I had planned on. So I ended up 120 negative. So we're going to come back to this in just a minute. But before I do that, let me go to the budget completed. So here's what happens at the end of my first month. I've got, again, my housing costs. I ended up with an extra $50 left over from what I had originally planned. My entertainment, right on track. Transportation, right on track. Loans, didn't have any. Insurance was $100 more than I thought it was going to be. So I've captured that. Taxes are following the plan so far. And now we get to the food. Okay, groceries, I had an extra $25 on when I went to the grocery store at the end of the, but on dining out, there's my $120. So I finished on my food category at the end of the month with a minus $95. Yeah, guess what happens if I continue that every month for the rest of the year? A lot of money comes out of that. So that's something I'm going to have to review and do something with, right? I'm going to skip savings for just a minute, and I'll come back to that. So my pets, I had nothing. My gifts I gave to my church, so that was actual for that. My personal care, right on target, and no legal funds. So I ended up, again, I spent $145 more than I wanted to. I say spent it, but it could be, I didn't necessarily spend all of that, but there's $145 I need to account for. And where I'm going to find that is you see at that same number up at the top, difference $145. I really have to make that zero. So the way I'm going to make it zero on mine is I'm going to come to my flexible savings. I wanted to save $285, but guess what? I only saved $140. So I ended up being $145 in the hole for my flexible spending. That now, of course, makes my net zeroed out where it, but I did not save as much as I wanted to. So that's how I ended month number one. All right, spending at least, yeah, spending $145. So I'm going to go back to my worksheet, say, what am I going to do about that now? So my fixed savings was good and my flexible savings, and I'm just going to pick saying this started in January. I spent too much. There was my $145. I'm budgeting to save $34.20 at the end of the year, but I can already tell I'm going to have an issue with that. So I'm going to have to start, maybe February, I do a little bit better and I saved $150 instead of $140. And I kept getting better and better. And I ended up finally in December is I met my goal for the month, but at the end of the year, I had only saved $2,675 against my plan on this one to save $3,420. And you may carry that over to the next year and see how you're doing. But that's what I would call the flexible savings does for you, is it gives you that buffer to say things didn't work out the way I wanted them to, but I still, in reality, did not spend more money than I brought home. I didn't save as much as I wanted to, but at least I didn't spend more than I brought home. So I'm keeping track of that, and and hopefully I'll get better and better with that as the months go by. Now, the one other category I want to talk about has to do with discretionary spending. Now, back to the budget. I put in red what I think, at least what I would call some discretionary spending. I don't have to spend it, but I do. Some people may think cable is a requirement, fixed cost, but I put it under discretionary. Netflix, movies. Let's see, what else? I have to pay my insurance. I have to pay my taxes. Food, dining out, that's discretionary spending. So I'm going to count that, and I'm going to count my flexible savings in there too, because that's what I want to do. It's not an absolute requirement. So I'm going to at least use that number in my discretionary spending. And clothing, obviously, my wife's, her clothing expenditure is non-discretionary, right? And mine is discretionary. So I included mine there. Just kidding. But anyway, I included half of the clothing as discretionary. So what do I end up with? Well, I wish I could show this a little bit better. I'll leave it like it is. After my fixed cost, every month, what I identified as discretionary, I have $765. That equals $9,180 per year. And again, this is for, a family income of two people. When I look at, and when you add those together, the couple is bringing their salary is about, in an hourly basis, is $57.69 combined. And obviously you have to pay taxes, so I'm going to take those out anyway. So it's really down to $47. But after I take out all of my fixed costs that I really have to pay, I have to pay for my house. I've got to put gasoline in my car. If I have loans, I've got to pay my loans. Those are things I have to do. But in this case, so after we paid all those, we had the $9,180 left over. And this is what I really want you to think about as you're budgeting. When I look at my hourly, what I would call my hourly discretionary spending rate. So I've taken the $9,180, I've divided it by 2,080 work hours a year, and it comes to $4.41 an hour. And that's our combined income, say, as a couple. So let's just say it's $2.20 each. That's when I go out and work and I'm getting paid, or let's say together as a couple, we're getting paid $57.69. We only have $4.41 of that to spend as we wish. The rest of it's already spoken for. Wow. So now when
That's
you're
shocking,
spending,
Pepper.
yeah.
Hold on a
So
second.
now
You're telling me that of the $47 I have to spend, it's all allocated and accounted for, and my only discretionary spending, what I can choose to spend is only
$4.41
Oh,
as a family. But this is a 2-income family. Well, it could be a 1-income family making $120,000 a year, but yeah, that's what I'm saying.
That might make me think twice before I go to $5. Just saying.
Yeah, it
That's
could
what
be.
I call Starbucks.
Yes, yes. So I just put a couple of notes here. So if I'm going to, I've got a discretionary, I want to go spend my money, $50. I'm going to go eat out, or I'm going to go get, not me, but, somebody may want to get a pedicure. I might want to go buy a new shirt, whatever, and it costs $50. I have to think about that. Really, I worked, and if, by the way, if it's a 2-person income and I'm only earning half of it, and I'm just thinking to myself, I had to work 22 hours of my discretionary income to buy that shirt. Is that really worth it? Maybe it is. Maybe it's not, but it's something that I really put in my head to say, gee, is that really what I really needed to do? Or maybe that's really not a wise use of my discretionary funds. Now, what if I want to go buy a new television? I want to buy a 65-inch instead of the one I have, and you're gonna go to Costco and find one for $1,000, right? Well, think about that. For the couple, the family income, 227 hours combined, right? So, and if I was gonna, again, just do it out of my only income, not including my spouse's, I worked 454 hours of my discretionary amount, right, that I'm getting paid to pay for that television. That television I have is not so bad after all. I think maybe I'll keep it for another year. So the point with that is there's where you need to think about, when you're on your discretionary spending, how long did it take me to earn that, and is it worth it? And I'm not saying don't be a hermit and never spend any of your money. Just think about it when you do that and make that decision. Is that a wise use of the money that God has given me, or should I be saving that for some other purpose that may be coming up down the road? So anyway, Ben, as we transition from the savings part and the budgeting section of today's message, what can you tell us about investing for the future?
Pretty enlightening, Pepper. I don't think I've ever seen that put in the perspective of my discretionary spending as a percentage of what I earn. And it's really enlightening. And I think it helps with this question that we're about to ask here. Our vision and our long-term goals, well, they really should help us to make better spending decisions now. That's really what it's all about. I think there's another aspect here. We're talking about savings as a part of that. Is there maybe something that we can do to better protect the savings that we're doing? You just gave us a lot of great information about how we can start to make choices day to day a little differently. But I think that maybe savings needs to take the step to the next level, because there is an area where protecting becomes a really big part of our longer term savings plan. And the biblical wisdom that we're going to call out here, Pepper, it's from Proverbs. A prudent man, that's a prudent human, man or woman, we can foresee that there is evil coming. And when we do, we have the capability of sheltering, hiding ourselves from it. This is straight biblical wisdom. And if we don't take those steps, well, what's going to happen is that we actually can just get caught up with everyone else and we can get punished. Well, we want to walk through and see what some of those things might look like in terms of what our savings impact could be. So at TRADEway, we always want to be able to call out these biblical concepts to help you to see how we can leverage biblical wisdom and to start to think a little differently. So the average recessionary bear. So we're talking about the S&P 500, where most of us would invest. Like if you've got those savings accounts, or the chances are you're also, as a TRADEway client, you're investing them in the market in some way. Well, take a look at the stat. The average recession, when it comes, it typically lasts for 14 months, and it has a 34% impact to your portfolio. How many of you like the idea of, like foregoing and having all of those savings that you just did and then have 34% of it cut away? Well, that's the possibilities that exist inside the market. unless you have some protection strategies. And that's what we really want to talk about, because what we're seeing happening right now in this extreme market that we're in, this very bullish push up that we are seeing has some similarities to the 2008 financial crisis. This decreasing monetary supply that the Fed is trying to manage is very similar to some of the very things that caused the 2008 financial crisis. And there's some pretty smart economists out there that are saying we might be repeating some of the same exact things that happened in 2008. And if you weren't around for 2008, or maybe you weren't investing and you didn't realize the impact of that, over half the portfolio values evaporated in 2008. In fact, the number was 56%. I think it might be worth saving my account from 56% drops just by applying a little bit of wisdom and having some help from people that think like traders with helping to protect my funds. Here's another chart I love to show. So the average S&P increase. This one I thought Pepper was, it's pretty interesting. I wonder, how many of you, just guess, what do you think? What's the average rise annual? You know, take all the downs, all the ups, just over a time frame of years, how much do you think the S&P on average moves up? And I will give you that clue. On average, the S&P does move up. Gene, you're saying 10. Any other guesses out there? I'll tell you. On average, it's 6%. So over all the years, just averaging it together, on average, the S&P goes up 6%. Now, that was actually kind of a little bit of a shocking number to me. Do you know why it's only 6%? Well, because let's go to the next slide. During the recessions, we have extreme declines. Extreme declines. These gray bars that you see on the screen over the years reflect the time in which our economy goes into what we call a recession. Now, a recession is when the economy isn't growing, when people aren't spending as much money, where businesses are cutting back, where families and individuals don't have money to spend. When there's a contraction in the economy from people not spending money, it's called a recession, and that dramatically impacts the value of the stocks that we invest in. So these gray bars show the time frames of those recessions. The blue bar, that is the value of the S&P, and you will notice that the largest declines that we've seen have been during recessionary periods. Getting back to those same stats I mentioned a moment ago, the average recession is a 34% decline. That's a substantial hit. That's, rounding, it's a third of your portfolio gone. It typically takes about 14 months to happen. And what we would ask as part of TRADEway is, why would you just buy and hold? Why would you, all the hard work that you've done to be able to manage those day-to-day decisions, why would you want to take a 34% hit when you know that over time, these things happen every few years? Because just look at the cycles. You can see they happen every few years. And getting defensive during those times makes a lot of sense. But that's not the way that most financial advisors think. We do, because we think like traders. Here's another one that I thought was really interesting. Now, some of us are hearing or seeing news articles out there that say, oh, we just did it. The Fed's got the soft landing. Everything's in the bag. The stock market's going straight up. Well, there's a few economists out there that do not believe that. So this stat just recently came out by Statistica Research. This is from July 17th. So here we are in August. This is a couple of weeks old. They have tracked the market's probability. It's the best way to put it. It's their probability, their forecast of the probability of the U.S. going into a recession, and they've done it for decades. So what's their current probability that the U.S. is still going into a recession? Well, good news is it's down. It's because last month, the odds were we were going into a recession at 70%. Yeah, it's only 67% probable right now that we're going into a recession. Oh, that sounds great. I mean, no worries. Let's just keep on going, right? There's nothing to worry about here. Yes, there is. There is still a huge probability being projected by those that watch the data. The economists in the background are saying we are in a very dangerous position, and that's not really what the market is reflecting. You know what? I apologize. That should say 2023. That is a typo on my part. Thank you there, Mr. Mark, for calling that out. So just imagine that this 2022 says 23. S&P 500 yield curve. Now, this is actually where that last chart came from, but I wanted to show you a different view of it. These areas where the red bars occur, like here, This is when the S&P 500 was moving at a specific rate. So these lines, this is the S&P 500 value. But what would happen is that you would see an inverted yield curve, and that might be a term you haven't heard before. Let me just briefly tell you. An inverted yield curve is when you get paid more interest. You give the bank your money, and they give you more short-term interest than what they give you long-term interest. So for example, treasuries. If you and I go out and we do a treasury today, the 3-year treasury is paying us about 5%. The 10-year treasury is paying us about 4%. Does that make any sense to you? Let's say I'll give you my money for 10 years and you're going to pay me 4%. I'll give it to you for 3 months and you're going to pay me over 5. Is anybody scratching their head at that one? That's nonsensical. And when you begin to see that nonsensical behavior happening in the economic system, how it eventually plays out is typically within 9 to 12 months of that occurring is when the economy goes into a recession. And when the economy goes into a recession, that's when those really steep declines have happened. And we're right about the 10 to 11 month mark right now. Where and how long ago did we go into the inverted yield curve? So currently with where we are right now in 2023, we are 10 to 11 months into that inverted yield curve scenario. This is about the time when stuff starts to get interesting. So we're raising the red flag at TRADEway to say, this is a great time for you to consider being careful, because this extreme bullishness, historically, these extreme bullish rises into timeframes like what we're describing now, they don't end well. So can we use knowledge to help protect our wealth? Can we be prudent? Can we be prepared to act? All of the great things we did to be able to leverage Pepper and Jenny's information about getting control of our spending so we can save. Well, can we also potentially save those huge declines in our portfolio? Well, if we're prepared to act, then I think the answer can be yes, we can. And if we know that these recessions happen and these bear markets happen, would it make sense for us to find financial advisors and tools that might help us to be able to be prepared? You're leveraging tools for your budgeting. You're leveraging information to be able to help drive yourself as you make decisions. What about tools and programs that can help you with being able to save during those bear market times? We think it's an important part, and it's what we do at TRADEway. Why? Friends, this is marketing from a competitor, right? It's on the screen, but I just won't say what it is. So let me just point out what I just said it. What these other investment advisors are telling you is that you really just want to build wealth slowly. Just a little over time, a little over time, a little over time, because that's how this works in the market. Well, that's 1, 2, 3, 4, 5, 6, 7. Let's just call those years, 7 years. And they're saying that over this, 7-year time frame, it's a whole lot better for you to just steadily build it, as opposed to making it really fast and then losing it, then making it really fast, then losing it, then retiring. Well, friends, even in this advertising, they're telling you the capability of you being able to make it really fast exists. And what they're not telling you, well, what happens if they are in a buy and hold mentality and you just saw 50% of your portfolio evaporate because you didn't actually follow the advice of traders? Interesting. All right, so just within this very messaging, there is a truth that they are telling you. It's hidden in the advertising that is possible for you and I to make money really fast in the environment of the market. It's also possible for us to lose it really fast. What's the difference? Knowledge, skill sets, and we would suggest the ability to understand the underlying economic cycles that give you the greater odds of being aligned with those cycles so that you can try to be positioned for these things that happen every few years, because they do. History is the guide. History is the guide. Are we going to ignore the history of the market that tells us these 34% declines happen on average and they happen during recessions? Am I going to ignore the fact that market stats are telling me I have a 67% decline or a 67% probability of going into a recession still, even here in 2023? Well, we think that there's a better way. So what we would suggest, well, why not get our help? Consider joining the AMP long-term program. We invest with a longer term perspective because we recognize those longer term cycles, although they might take a while to play out, they're very powerful and they're predictive of what the economy is likely to do in the future. Our registered investment advisors, people like myself, Jenny Taylor, David Verbugen, we work with the long-term investing team to help create a plan to help you to protect your wealth. And if you're leveraging our services, well, often what people will do is as we tell them what we're doing, they may take the same advice and they may go apply it into their 401k portfolios where they have specific control over the assets in them. Our amped investment team, well, what we do is we allocate based off the cycles. Are we in a bullish cycle? We diversify across bullish positions. Are we in a bearish cycle? Well, we're going to get defensive. We have the capability of making money in inverse ETFs. You might not have ever heard that before. An inverse ETF actually increases in value as the market drops. Now, conversely, if you're in an inverse ETF and the market is rising, well, the value of that's going to go down. But we have the capability of being able to help you with aligning to those market cycles based off the long-term tone. Amped, assisted, managed portfolios by TRADEway. Yeah, I guess I took the slide out that talked about that, Jill. It's a great question. Assisted, managed portfolios by TRADEway is what AMP stands for. And it's David Mitchell's investing methodologies. It's designed for wealth preservation. It's designed to match up with the long-term cycles of the market. We have different portfolio types, different risk categories, and it's designed for what we talk about at step one. If you've been to our seminars, you know David advocates, look, put 80% of your money in a safe, how you're going to protect it, portfolio management. That's what this program is designed to help you with. So when we talk about amped in the long term, your 80% savings, we want to preserve it, particularly through the bearish cycles. Now, what about the other 20% money? On the TRADEway system, we would suggest that you trade that money. But what if you're still learning and you're not ready to trade? Could we help you with that? Yes, we can. Yes, we can. We call it the Ultra Portfolio. I'll tell you more about that in just a minute. So moving funds to amped is actually pretty simplistic. Most of these programs that you're engaged with today don't have good bearish options. Most advisors don't make money if you put yourself in cash or if you're in positions that are considered bearish positions. Most investment advisors and most financial advisory firms make money in the bullish times. And they make their money even in the bearish time trends. So usually it's the investment individuals that are getting that short end of the stick. But you can ask your benefits administrator this question. So your 401k administrator can say, how much can I roll over to an IRA? And if they're telling you that you can roll over a certain amount of money, well, we can help you with that. And our team would help you to be able to create an account at a broker that we partner with. It's called Interactive Brokers. And Interactive Brokers is an amazing technology partner for us. People like myself, Jenny Taylor, we can literally click a button and allocate hundreds and hundreds of client portfolios based off the trader methodologies that we leverage. So as we invest with the cycles, we'd suggest that a minimum account size of 10,000 is really the sweet spot for us. And there's one other really powerful feature here. Your banks don't pay you a lot of interest. Interact brokers, when we are in cash, they're paying 4.83%. 4.83%. That is a huge payment for your money to be in cash. So when we are being defensive, you'd still get access to that amazing rate. Now it's scalable based on how much you have invested. Anything over $10,000 is eligible for that rate. You won't get that full rate unless you have over $100,000 at Interactive Brokers, but still, that's a very powerful opportunity for many of you that are looking for alternatives for where you can actually park some cash during cycles of the market where things don't make a lot of sense. We leverage biblical wisdom, friends, for everything that we do. And, biblically, Ecclesiastes tells us that we want to diversify. And straight from these passages of scripture, David Mitchell created the amped system. Let me just tell you, the risk return principles, the reason to diversify, all of that comes into why we do what we do. See, we leverage the Bible to help protect your life savings. And we divide into 8 categories. These are during bullish times. We can see 8 different parts of the economy, and we can actually see 16 subdivisions And these are the things that we know today that we can help you to invest in a diversified manner as a part of the Assisted Managed Portfolios by TRADEway program that we're telling you about right now. What do you get? Well, you get our help. Biblical wisdom, diversification, high yield access to interactive brokers, and frequent updates from our team telling you what it is that we see happening in the market and why. Want to get started? Well, pretty easy, friends. Our program that we think about most is called AIM, where we press the buttons for you. Now, we do have a pro offering where you can press the buttons. If you want to be able to learn more about this program, what I would suggest is let's go ahead and schedule an appointment to be able to talk with one of our advisors. The Ultra Portfolio is also available to you. If you want to get 20% help that we talked about, we can actually trade it actively with you. We do recommend a $10,000 account size. $25,000 is better, but we actually are in and out of many different trades. In fact, I was doing some statistics just the other day. Since March, our team has done 146 trades in the Ultra Portfolio. Since March. Pretty active. Would you like to know more? Well, why not meet with one of our advisors? You can meet with myself, Jenny Taylor, David Verbugen, one of our advisors. We'd be happy to get with you if you want that appointment. It's very simplistic. Even right now, you can go out to tradeway.com/amped, or you can email amped@tradeway.com. Please schedule an appointment with me. What will happen, we'll send you back an invite. You get to pick a time on my calendar or Jenny's calendar that matches up with you and your time frame, and we'll answer your questions. It's a chance for you to get your questions answered with a financial advisor who understands the way that the market works. This is more about us helping you than anything else. When's the last time you met with a financial advisor who understood how things work behind the scenes? Let us help you. That's what we're here for you. And if you want our help, that Ultra Portfolio can be a great opportunity for many of you who are just now starting to learn how to trade. Would you like to be able to let TRADEway's people trade those funds for you while you grow and gain your competencies? Well, that's what the Ultra Portfolio is all about. As we close out, can I just say thank you? And sincerely, thank you. This was a great opportunity to sort of look behind the scenes about how we can manage our money, how we can save our money, how we can think differently about the future. If we can help you, we'd love to. Just reach out to us at tradeway.com/amped or send an email, amped@tradeway.com. And we'll be happy to get more information to you. Thank you so much for being here today. Jenny, you did a great job. Pepper, thanks for sharing the spreadsheet. It was awesome.
Thanks, Ben. I enjoyed doing it today, and hopefully we'll be able to help people make a few changes to their budgeting.
Awesome. Well, saving money is one thing. That's that daily decision thing. But I also think that we have to think about saving it for the long term.
Yeah.
I do think avoiding those bear markets is a huge part of my long-term planning. So glad that we could kind of expose that thinking for all of you. And I appreciate you being here today. Pepper, thanks for the great information.
All right. And again, thanks to all the people that attended. We appreciate it.
Thank you.
All right. We'll see you soon. Again, if we can help you, just reach out tradeway.com/amp or email amp@tradeway.com.